You want to know the single most common, most easily fixed mistake that I see retail investors making? It surrounds one simple term that's always thrown around that I think few investors truly understand. A failure to understand how yield works is the most common mistake I see retail investors make. Time after time, you'll see people throwing around a yield number without any context whatsoever. Today, I'm going to teach you 3 important lessons about yield in a language that anyone can understand, the Queen's tongue. Let's say I wanted to sell you an asset that maintains its intrinsic value and generates yield in perpetuity. Sounds pretty good, right? So you give me $100 to invest, I take your $100 and I start paying you yield on it. And here's what it looks like. So as you can see, in year 0, of course, we have the $100. In year 1, I take $5 of that 100 and I give it back to you. That's a yield of 5%. We have $95 left. The next year, I take $4.75 and hand it to you. Again, a 5% yield, etc., etc. What's the takeaway here? You need to pay attention to income, not yield. Yield is simply the income generated by an asset. It's typically measured by taking the past trailing 12 months of income and then dividing that by the asset's current price. Yield tells you nothing about where the income is coming from, whether it's a debt repayment, whether it's a share of profits, a return of capital, as in the example I just gave you, etc. Now, yield can also change very quickly. So if income halves next year, your yield's going to halve as well. Now, the most predictable sort of income is what they call fixed income intuitively, or bonds. Let's say a company borrows $100 and pays a interest coupon of 5% every year. That's a 5% yield, right? At the end of the term, they then pay the money back. So a $100 bond paying out $5, 5% yield. But we need to take into account if the price of the bond fluctuates, which they do. So if the price of the bond never changes, your yield's going to sit at 5%. We understand that, simple. However, if the price of that bond increases to $200, the yield's going to drop to 2.5%. Again, simple math. However, what's more likely to happen in the case of a not so good company is that the price of the bond drops. Let's say it drops to $50, it halves. Well, yield is going to increase to 10%. That's because that debt just got way riskier, and whoever's holding it needs to be compensated for that risk. There is no free lunch. The reality is that the prices of bonds do change over time, but not by very much. So here we can see the Vanguard Total Bond Market ETF, ticker BND. We can do the math of the last 12 monthly payments, so this ETF pays you income every month. We can divide that by the asset's current price. We get a yield of 3.9%. Now, what's interesting about bonds is that they don't fluctuate very much when it comes to price. Now, if you're interested in learning more about bonds, you can see our recent guide to bonds, which covers everything. Now, let's go from talking about what one of our subscribers coined return-free risk to risk-free return. So when you put money into a bank in a savings account, the interest that you receive is typically considered to be risk-free, because the only reason that you wouldn't receive your money back is if there was systemic risk and the bank went bankrupt. But of course, in our piece on what happens if Schwab goes bankrupt, we looked at FDIC protections that help ensure you get your money back in the case of black swans happening. So in this case, American Express keeps trying to email me and get me to deposit $25,000. And if I do that, they're going to give me a $350 cash bonus. So this is largely risk-free. I'm going to get my money back, and they're going to pay me what is effectively a yield of 5.25% for that first year. So it's the 3.8% they're promising there, plus that $350 cash bonus if I deposit the minimum $25,000. Now, I can pull my money after 60 days, and then read the fine print, and it says you need to wait up to 12 weeks on top of that. Okay, fine. So after 5 months, I can pull my money. I can get that $350 and whatever interest I received. But when you look in that fine print further, as you should always do, you see they say interest rates and APY subject to change without notice. Of course, what banks do is they try to offer the highest savings rate possible to attract capital. We can see some other banks doing that. I've used CIT Bank before when they've had similar deals, just deposit the cash, remove it later, and get their bonus. But this is risk-free, you should be able to get upwards of 4% here. Again, interest and APY subject to change without notice. Now you can avail yourself of certain options that allow you to lock in the yield over a particular duration. But let's go back to talking about the most important lesson that we've learned so far. Yield is a function of income. If income payments are consistently declining over time, your yield is going to decline as well, unless, of course, the price of the asset declines too. Now, if income payments are increasing over time, yield's going to go up, unless the price of the asset goes up too. This is what you see with DGI stocks. We're going to look at an example of that. Now, if income payments are random, that yield measure becomes largely meaningless. This is why companies distinguish between dividends and special one-off dividends. I'll show you an example here. T. Rowe Price. You can see that special dividend they paid in 2021 is excluded from the dividend growth rates that are reflected here. So as you can see, for a dividend growth stock, you get this nice, pretty upwards trend of your income increasing every year. That's what a dividend growth stock is all about. Now, you need to be very careful when you see higher yields. Here you can see for T. Rowe Price a historical 5-year yield average of 3.16%. Then you look at the current yield of 4.29% and say, wow, what a bargain. Well, not necessarily. There's a reason for that, and we covered that in our recent piece on asset managers that are running into problems. This brings up the question of whether a stock represents value or a value trap. We've covered a fair number of examples in the past. This is a present example. It's a firm called ADM, Archer Daniels Midland. They have a historically high yield at the moment that's risen pretty sharply. Now, that's a function of the price of the stock dropping as well. But we need to be very careful when we see high yields because they're usually a red flag. That's why in our methodology, our Quantigence Q-score methodology, we stop rewarding yield. I think it's above 5%. Generally speaking, when I see a stock starting to approach the 5 to 6% levels and it's not a REIT and it doesn't have a history of paying such a high yield, I start to get very suspicious. There is no free lunch. A great example of that would be yield max ETFs, which we recently did a piece on. Here you can see yields 70%, 40%, 23%. We explained in that piece exactly what's going on here. Again, there is no free lunch. Now, there's really 4 profiles of income that we're discussing today. You have income that stays the same or roughly the same over time. You can think of fixed income or bonds, right? We see a steady rise of payments every month for that BND ETF we looked at. You have income that follows a trend over time slowly. It's not sporadic, and you see that in savings accounts that react to interest rates being raised or lowered. You have income that steadily increases over time in a predictable fashion, ideally enough to offset inflation. That's dividend growth stocks where most of our money is invested in our Quantigence strategy. Then you have income that occurs sporadically. This is the case for many dividend stocks, and I've thrown one up here as an example. This is Devon Energy. So you can see here that in 2023, it seems that their dividend yield breached 10%. So somebody who's chasing yield would have been like, buy, they would have bought shares. Well, what ended up happening is that income halved and so did their yield. So you can see that fall to around 5%. So is it suddenly not a good buy anymore because the yield fell? No, you need to focus on income, not yield. That's not the right metric to be looking at. You need to look at where dividend income comes from. So when a company generates profits, they can do a number of things. They can invest back in the business to generate even more profits. That's what a growth stock would do. Or they can return the money to shareholders in a number of ways. You see this with value stocks. They can buy back shares, they can pay dividends, or they can even pay special dividends. Those aren't very common. Most companies have a dividend policy. So that's usually a target payout ratio. Payout ratio is the percentage of their profits they give back to shareholders in the form of dividends. If you have a low payout ratio, it gives them a lot more buffer to increase over time. You see that metric monitored very closely for dividend champions. We monitor that metric in our strategy closely as well. Now, Devon is an interesting example because they have a partially variable dividend that's tied to free cash flow. That's the variability that we saw there. Now, there's 2 ways a company can increase profits. They can either increase revenues or decrease costs. So growth track records of dividends or income are tough to sustain through market turmoil, and they become increasingly impressive over time. This is this notion of dividend champions, where you see a consistently increasing income component over time, and a champion has increased that income component for at least 25 years in a row. That's remarkable. In our core universe, the average is 46 years in a row. It's a very impressive feat. Now, what you can then do with this increasing income is you can avail yourself of Buffett's eighth wonder of the world. Compounding over time works magic. When you reinvest your dividends, this is called the snowball effect. Now, intuitively, reinvesting dividends for an asset where the income is consistently growing is going to outperform assets that aren't. Now, our Quantigence performance paper shows how powerful dividend reinvesting can be over time, as we looked at our strategy over several decades, spanking the S&P 500 simply because of that dividend growth component, that income growth component. The other thing that you ought to think about is yield on cost. So let's say you invested $100 in Stryker, but you say, well, it's only paying a 1.7% yield, Joe. But just hear me out here, okay? That dividend or income is growing 15% every year. So it has over the past 10 years on average. And of course, that's no guarantee of future growth, but just hear me out here. So if you did invest in Stryker and that income increased 15% every year, by the end of the 10th year, your original investment is now yielding over 7% on the money that was originally invested, what they call yield on cost. Buffett receives half of his initial Coke investment every year in dividends. That's how powerful yield on cost can be over a sufficient period of time. Now, what else happens when that income is increasing is that the share price will adjust accordingly. It's why at year 10, you don't see Stryker having a 7% dividend. They'll probably have something a lot smaller than that. And we can predict that just based, you see here on their dividend yield over time. You see it's crested 3% there on a couple occasions, but it's largely stayed quite low where it sits today below 2%. That's because quality companies trade at a premium and you rarely see yields get very high. It's why when yields do spike quite high, it's a red flag, as I discussed before. Let's go over 3 lessons here. Pay attention to income, not yield. Is that income consistent? Is it trending in a particular direction? Is it sporadic, which is not good? Always identify where your income is coming from. When somebody over at YieldMax promises you a 70% yield, you need to question that. When you see a particularly high yield stock, look to see if that's a one-time payment. Oftentimes that's the case, and a lot of investors will say, look at the yield, and they won't even realize it's just a one-time instance. Is a manager just handing you your money back after taking their fees? We saw in our YieldMax video how that's feasible for them to do. They can simply hand NAV back and then call that yield. You need to consider where the income is coming from. And of course, you always need to consider total return. Income is just one component of any investment. Sure, over time, the more time you let pass, the more income becomes a bigger component of total return when you look at the stock market. However, it's just always a component of total return. Remember, you can generate income from any asset. You know how you do it? You just sell some of it. So this goes back to our concept of the new 4% rule, right? Creating your own 4% yield simply by selling 4% of your assets every year. So you may be wondering when the right time is to sell a dividend stock when you see the yield spiking, and we've covered some great examples in this next piece. Please give it a watch. Thanks so much for taking the time to watch this video today.